Let's talk about kind of one of the hot incentives that are out there at the moment. This is the Work Opportunity Tax Credit. The credit has actually been around for quite some time, since 1996. And the idea behind the credit is to promote the hiring of employees who may meet a certain target group, which we'll talk about that here in just a moment. If an employer hires such folks, then they will be entitled to, the employer will be, for a dollar-for-dollar reduction of their tax liability or a tax credit on the employment of that employee, and we'll see how that works here in just a minute. The program does have a carry-forward provision of these tax credits. There's a 20-year carry-forward of the tax credit in the event that you don't utilize it the year that it's identified. There's also a carry-back provision that allows you to carry back that credit 1 year. So with that said, let's talk about the target groups and the tax credit amounts. So the target groups and tax credit amounts are essentially kind of broken up into two sections. The first is the target groups A through H, and those are broken up that way because those are credits that are generated over one employment year. It's important that we kind of unpack that a little bit to know exactly what it means in terms of the employee qualifying on an employment year. Say, for the sake of argument, that you hired somebody on June 1st of 2016, right? That employee, then at that point, assuming that they fit the criteria, which we'll go into here in just a second, and assuming that they at least worked 120 hours, as you could tell from the slide up here, would then be a qualified employee that you can actually take some tax credits on your income tax returns, right? That employee's employment year starts on June 1st, 2016. And just for simplicity's sake, let's just say that that employer is on a calendar year basis as opposed to some sort of other fiscal year, right? If that's the case, then that employee's first employment year is going to end on May 31st of the following year, which of course bleeds into another reporting period for that particular employer. Essentially what that means is you need to take some of the credit, assuming that they stayed with you, for that first year in 2016, and the residue would be taken in 2017. Again, there's a few assumptions that are in there, but for the most part, that's how it would work. So the first section of target groups is only one employment year. Target group I, which we'll talk about what qualifies under target group I, actually goes through 2 employment years, right? So if the employee sticks around with you, that particular qualifier can bleed into 3 reporting periods, right? So it could be 2015's returns, 2016 returns, and 2017's returns. So a fair amount of tracking that goes in to making sure that that gets done correctly and then obviously placed on the tax returns. Okay? Here's a little savings example. Let's assume that there's 25 eligible employees under the target groups A through H, and then there's 25 eligible employees under target group I. Over a 2-year period of time, this is actually kind of a light figure, but over a 2-year period of time, the savings for that business could be as much as $285,000, if not higher. So obviously it's a lot of money that we're talking about here that the employer can save. And remember the carry forward and the carry back provisions, right? So if you, for example, this year had a year where you were in a loss position, right, as a business, the credits cannot offset against taxes that you don't owe, right? So you don't owe taxes in that year, but maybe the prior year you had a screaming year. You can amend the prior year return. You can then request a refund claim and get that money back to you from the IRS. Okay? So how do people qualify? Okay, so the employees must meet at least one, but only one is necessary, of the following criteria at the time of hire in order to be considered eligible for the WOTC. And WOTC, again, is the acronym for Work Opportunity Tax Credit. But to be clear, they don't have to meet a multitude of criteria. They just have to meet one, and then they have to meet that hours requirement that we talked about earlier. So veterans, for example, they are qualifiers. And there's a whole slew of different ways that a veteran can qualify, but veterans specifically could give you the highest total of tax credit per qualified employee at $9,600 for any one qualified employee. Significant amount of dollars that you are reducing just for one person. Folks, this is a brand new one that just came into play in 2016. Unemployed individuals that have been unemployed for at least 6 months. We are finding that that criteria alone is being used all the time for qualification. And so in the past, we saw kind of a mix of veterans, folks that had received aid, and maybe folks that had a record in the past, right, as a primary 3 criteria that were getting you qualification as an employer. Now, unemployed individuals as a criteria is blowing that out of the water. And they are by far the most qualified under that criteria than any other criteria. So that's, again, one of the criteria. The recipient of aid is also pretty big, and that's really because the recipient doesn't have to be the employee. It could also be that their family is receiving the aid and they're just part of that family. And so based off of that, they can get, the employer can get a tax credit off of that. Okay, so let's talk a little bit about why this program in the past has not been utilized very well. Number one, there's obviously a fair amount of hoops to jump through. Your employees must take some sort of survey at the time that they're hired for you to even to be able to identify if you have qualified employees to begin with. You then have that stringent 28-day requirement, right? So you have to liaise with the WOTC centers and make sure that the paperwork of these employees arrives there within that time and that you are able to get a voucher. It's a certificate that the WOTC center issues out for that employee. As you can imagine, if you're trying to do this by paper, 28 days goes by very quickly. Therefore, we had seen in the past, after doing this for now 15 years, that many employers may have tried to do this credit work, if you will, and they just were not successful. So what ended up happening is they would throw the towel in, right? So this is too much work. It's taking too much time of our HR or whoever is responsible for hiring the employees, and we're getting no benefit out of the deal, right? Enter the proprietary software that our firm has created. So over the course of several years, we have created a software, web-based tool, if you will, that allows our clientele to actually process their information for the WOTC the day you hire the employee. Now, it's a simple set of login credentials that the employer would receive that they could pass along to their employee, if you will, and the employee can, just like they would with a credit card or something else, put a username, put a password that we would provide, and they would then take this survey, and when they hit submit, instantaneously we receive it to process it, right? So effectively, we beat that 28-day requirement by 27 days every time. The goal of our software is to achieve what I call 100% participation of your employees. Now, we all know that if you have more participants, that's more qualification and therefore more tax credits and more savings on tax returns, right? Now, for the employees, what they see when they actually access the software tool is a little welcome letter that says, hey, congratulations on your employment. Your employer participates in this tax credit program. This does not affect you in any negative way. Please be truthful with your answers. If the employee does not speak the language, right, of English, they can select multiple languages, if you will. So you can have it in Spanish or whatever language is their first language. That way they understand what they're filling out, as opposed to just trying to fill out a form that they have no clue what they're signing on, right? The survey has also been set up in a manner where it's super easy to understand and takes about 3 minutes to complete by the employee. It's just part of their hiring practice now, right? When they're filling out an I-9, a W-4, an employment application, they'll just complete the survey, submit it, and then effectively you're taking advantage of the tax credit by achieving that 100% participation. Our software also has an I-9 and W-4 module as part of our software that is customizable to the client if they would like to see that. Okay? All right. We talked about this a little bit, but that top bullet there speaks to vouchers. So what are the vouchers for? The vouchers are submitted to the WOTC Center, and the WOTC Center then issues out certificates per employee. Well, that's really important because this type of analysis can and sometimes is audited by the Internal Revenue Service. When the IRS does review it, they're going to ask you for those certifications, right? So this is your audit support, if you will, or part of your audit support to make sure that you are indeed entitled to the tax credit. we do that for our clients, essentially get a limited power of attorney signed by our clients so that we can liaise with the WOTC Center on their behalf. Okay? Also, we complete all the schedules. As you guys remember from earlier, it can get a little complex with how the numbers shake out on the calculations. So for CPAs that are focused on tax and audit, they're not wanting to mess with that. We'll provide that for them. They will have everything they need to complete the tax returns. All right? This slide just kind of shows you a screenshot of our entry portal to our software solution. Again, there's an access point for the employee. There's also an access point for the employer. The employer can access the information, everything that's been submitted, and it'll be essentially a repository for all the data that's being collected of the employees for this incentive. Okay? And lastly, this particular slide just shows you, essentially what the employee would see when they're filling out their data for this particular tax credit. So, that being said, before I move on to the next incentive, the California New Employment Credit, a few things to remember that are really, really crucial. Number one, there's a current opportunity to get retroactive tax credits all the way back to January 1, 2015, but that opportunity ends on September 28th of 2016, okay? Also, it should be known that our qualification rates that we had seen in the past, before the software and then before the new criteria for unemployment, were teetering around 5 to 10%. They are now closer to 20 to 25%, right? So I get a lot of clients that say, well, I don't think I'm in the industry, or I don't think that we hire these types of folks. You'd be shocked, right, as to what your qualification rates would be. We are averaging, doesn't matter what industry, between 20 and 25% qualification of all employees, so keep that in mind. Last thing I'll mention is that just as crucial as it is to go backward and try to capture this current tax credit, it's even more crucial to set it up going forward. The program is intact through the end of 2019, and the goal should be to kind of set it and forget it. Get the system set up. Once it's set up, it's super easy. It takes 2 to 3 minutes for an employee to complete the surveys, and then you're locked and loaded and good to go, and you essentially stop leaving money on the table. And that's pretty much it, unless there's any other questions on this particular incentive.